Hey everyone, Dan again, Stocktrades.ca, back at you with another video. Markets are starting to become a little more shaky. We're seeing that volatility again, not like we saw in March when, a 4 or 5% swing in either direction was becoming the norm. But they are starting to get rocky as earnings come out. And the thing is, most companies are reporting earnings from January to March right now. So these don't even have the effects of COVID-19 on the whole quarter. We expect second quarter earnings to actually be worse for some companies. And we really don't think we're out of the woods just yet. So our most popular videos here at Stock Trades and content on Stocktrades.ca is figuring out what stocks you should be buying. But I'm going to do a little different take in today's video. I'm actually going to talk about 3 stocks that I think you should be avoiding right now. A lot of investors are rushing into the markets right now, whether it be to get in on the upswing or in one particular stock I'm going to talk about, they just have a fear of missing out. Just a quick mention before we start the video, we are having a sale on our premium end. It's 40% off right now. We only run these discounts every 3-4 months. So if you want to check us out, I'll put a link in the video here and I'll also drop a link in the description. And just to clarify, it does come with a 30-day money-back guarantee. So if you want to join over 1,000 other Canadians that are using us, feel free to check us out. Feel free to drop your questions in the comments section below as well, or you can shoot me an email. With that being said, let's get straight to the video, which is 3 Canadian stocks I really think you should be avoiding right now. So before we get into the first stock, I just want to make one thing clear. By me saying you should be avoiding these stocks right now, in no way do I mean if you're a holder of these stocks that you should be selling them. There's a clear difference between the two. Just because a stock doesn't look like it's a profitable buy right now does not necessarily mean you should go and dump your shares. Before COVID, Air Canada was one of the most efficient airlines in the world. They have a significant economic moat here in Canada. The only other airline that really competes is WestJet, whereas down south there is a multitude of airlines that compete against each other on a regular basis. They've made key acquisitions with Transat and Aeroplan, and they've been one of the best growth stocks over the last decade. A purchase of Air Canada right after the financial crisis and a sale at its peaks would have you earning over 5,000% returns. And the thing is, people think that travel is just going to resume and everything will go back to normal after this, which it might. There is a possibility, but there is also a possibility that COVID-19 has changed the landscape for airline companies forever. Air Canada generates a significant amount of its profits from business travel. And if you're someone who is working at home right now for your company, you can see how easy it is to communicate over the internet using video platforms. Whereas prior to this, businesses might have flown employees to a central location to have meetings, conferences, etc. So after the dust is settled from all of this, companies are going to see that there is a potential to save money. You can look at me right now. I'm broadcasting this to thousands of people in 1080p on a high-speed internet connection and a $600 or $700 camera. A lot of people do raise the issue of security, and this could be an issue, but this is an industry that is quickly evolving as well. There's a very small chance that passenger travel will be hurt over the long term. Once COVID-19 subsides and we get a vaccine, people will start traveling again. There might be short to mid-term growth concerns from Air Canada because of a lack of passenger travel. But the thing that really concerns me is the long-term business aspect of it. Canadian investors are not the only ones trying to catch a falling knife right now. The airlines in the US are struggling. They're struggling significantly harder than Air Canada, yet people are still buying them. And I think one of the primary reasons of this is people think that things are just going to go back to normal in the snap of a second. Air Canada posted an operating loss of $433 million in the first quarter of 2020. This can be compared to operating income of $127 million in 2019. When comparing quarter-to-quarter numbers like this, year over year, Air Canada had saw 27 straight quarters of revenue growth. That streak has come to an end, and the company is currently in cash preservation mode at levels we've never seen before. Cost reduction programs are expected to save the company a little over $1 billion, and they have drawn down or borrowed just over $1 billion from their revolving credit facilities. And they also just recently reached an agreement where they put planes and spare engine parts up for collateral to secure another $600 million loan. In terms of balance sheets, Air Canada's is healthy right now. They're able to cover short-term debt obligations, but the issue is we don't know when this is going to end for the company. Are they doing everything right to preserve their position right now? Absolutely. But the fact is, an investment in Air Canada right now comes with a huge degree of speculation. The longer this is drawn out, the longer the company needs to rely on debt to survive. If you are looking to take advantage of an airline stock during times like this, look for those that have defense spending, military spending, consistent revenues. They don't rely strictly on passenger and business travel. You should be focusing on investing in companies with strong fundamentals and consistent cash flows, which moving forward we can expect Air Canada to have neither of those. We really don't want to be investing in a future that is so cloudy. We've seen a lot of panic selling over the last couple months. The market surged back in April, but we're starting to see sell-offs again. But this stock has actually got investors panic buying, and not because the fundamentals back the stock price, but simply because they have a fear of missing out. And this stock is Shopify. Now don't get me wrong, I love this company. I love the way they're growing. In fact, we recommended Shopify to premium members in December of 2018, I think for around $166. And it's now trading at over $1,000. Me personally, I had an average price point of Shopify in the $160 range, and I actually sold the stock recently for around $600. As of right now, it looks like a huge mistake, but there is a very good chance that this rally that Shopify is seeing right now is simply unsustainable. And investors who are buying in at these $1,000 plus price points may get into a bit of trouble. During this COVID pandemic, tech companies are still performing, and they're still performing well. And as such, we've seen a bunch of Canadian tech stocks jump in price, and they are severely outperforming the market. The one staggering thing about Shopify is how it's outperforming its technology peers. Shopify's stock price has essentially doubled in a little over a month. Compare this to a major company like Amazon, who has returned 23% over the same time frame. Now, the growth we're seeing from Shopify year over year is substantial. We're seeing revenue growth in the 47% to 50% range, and the company is now the most expensive company on the TSX. And the thing about this is they are still not profitable. So Shopify earned about $1.5 billion in 2019, and it currently has a market cap of around $123 billion. To put this into perspective, let's look at the second largest company in Canada, which is Royal Bank. The company currently has a market cap of around $119 billion, and it has about 1.42 billion shares outstanding. If you look at the company's dividend on an annual basis, it pays around $4.32 a share. So over the course of the year, Royal Bank will pay out over $6.1 billion in dividends. So yes, Royal Bank pays out 4 times Shopify's revenue just in dividends. And Shopify, on a market cap basis, is worth more. Will we see Shopify continue to post this growth? It will eventually slow down, but over the short term, I would say yes. However, investors often fall into a trap of just paying whatever they have to get into the stock right now. And as you can see, this is clearly happening with Shopify doubling over such a short amount of time. The company is seeing a huge surge in new store openings because of COVID-19. The fact is, after the dust is settled, how many of these retailers will become long-term paid subscribers? Analysts see very little upside in today's price levels, and I tend to agree with them. Let me reiterate again, this is an excellent company that has gained a ton of attention lately and caused its stock price to skyrocket in a short amount of time. So I am still looking at Shopify after I took profits, but this is just not a price that I'm comfortable paying right now. So the third and final stock I'm going to talk about, and before I do talk about it, just want to remind you, if you'd like the content, head down and subscribe to the channel, like the video, comment on the channel. It helps us produce more content, and it lets us help more Canadian investors earn more. So the final stock, and it's one that I actually own, which is why at the start of the video I reiterated that by avoiding these, I do not mean selling these, and that is Suncor Energy. Now, Suncor is one of Canada's biggest oil and gas companies, and they've garnered a lot of attention over the last while simply because of their drop in price. But on a macroeconomic basis and just fundamentally moving forward, I just don't see the company as being a solid pick. A lot of people who are buying this company right now aren't even looking at the environment Suncor is sitting in. They're simply saying the stock is 50% off lows, oil isn't going anywhere, let's buy the stock. And there's a couple reasons that I feel Suncor may struggle moving forward. For one, the federal government just announced that it will give aid to major companies seeking it, But one of the primary conditions of this help, and for me as a taxpayer I completely agree with, is the fact that the company is not allowed to distribute dividends until the money is returned. Suncor already slashed its dividend. In fact, there was a ton of oil companies that did. Royal Dutch Shell actually cut their dividend for the first time since the Second World War. This shows you how bad it really is in the oil and gas sector. And the fact is, we want to invest in companies that can provide us with reliable cash flows moving forward. And I think we're seeing in the last decade that these companies are anything but reliable. And this isn't their own undoing. They're extremely efficient companies. Suncor, Canadian Natural, which by the way, Canadian Natural did not cut its dividend. However, it's been shown that the price of oil can essentially be crippled on a whim. This just isn't something that I am comfortable investing in. And even though I do own Suncor, and I believe the stock is undervalued today, I am looking to exit my position once I gain back some of my money. Now, it's a fact that over the last 15 years, investing in major Canadian oil companies has been nothing short of a disaster. Suncor has a compound annual growth rate of 0.84% over the last 15 years. Sure, the dividends are nice, but you have severely underperformed the overall market. And even though that compound annual growth rate is abysmal, it hasn't even been the worst out of the major players. Imperial Oil actually has a compound annual growth rate over the last 15 years of negative 1.64%. The only major company that stands out right now is actually Canadian Natural, one that I own as well, and one that I probably will own moving forward. They have a compound annual growth rate of around 3.47% over the last 15 years. If you include dividends, this actually isn't that bad of a return, and it has been by far the best performer out of the major companies. The fact is, at today's price levels, yes, Suncor is undervalued. And could you make money over the short term buying them? Absolutely. But is this a stock that I want to hold in my portfolio with a 10 plus year time horizon? In my opinion, no. Like I've showed you over the past few years, 2 of the 3 major players have proven to be terrible investments. And more importantly, over the last 5 years, we've witnessed catastrophic collapses of the oil market by Saudi Arabia on a whim. The first time it happened, I kind of shrugged it off. But now that it's happened again, this just isn't somewhere that I'm comfortable parking my money over the long term. COVID-19 has accelerated this, yes, but the flooding of the oil markets was going to happen eventually, and reports are coming out now that countries in OPEC actually aren't following production cuts. Once the effects on the oil market from COVID-19 have started to subside, they could easily just flood the market again. There's a lot of love from Canadian investors on Canadian oil companies, and our country relies on it. However, that doesn't necessarily make it a good investment. And overall, if you're an investor looking to take a position in an oil company right now for the long term, I just feel your money could be better invested elsewhere. That's pretty much it for the video. Short video today. Just wanted to go over 3 stocks that we're getting a ton of questions about. I mean, with over 1,000 members over at Stock Trades Premium, we literally spend all day answering these types of questions. So I just thought I'd bring a few of them to your attention, and I definitely want your guys' opinions. So drop it in the comments below, subscribe to the channel, like the channel, and stay tuned for another video next week. Till next time.